Good afternoon, friends. I'm Sandeep Biani, heading business development and sales for Alpha Credit Advisors. Welcome to Alpha Credit Advisors, AAA Investor Connects. Friends, 2024 started with a bang as all major market indices like Nifty, Nifty Mid Cap, Nifty Small Cap surged to new highs. With increasing retail investor participation, risk appetites are poised to grow as there was transition from FOMO, like fear of missing out, to ROMO, regret of missing out. The irony is that sideline cash may keep a relative floor on how far market can correct. If we can do just one fun activity with our family or friends, like just to ask, who's waiting to buy an equity market sell-off? And we can subsequently ask one question, at what levels? Our sense is that most people will say 5 to 10% lower. Yes, that's 5 to 10% lower. With that being said, we believe that earning easy money will not be so easy from here on. It is time to start focusing on capital protection while ensuring to capitalize on opportunities presented to create wealth. Don't get us wrong, we are quite bullish on the India story, but that does not mean compromising on the quality of our investments. In nutshell, there is a highway ahead. Just keep our state seatbelts on. Enjoy the ride with your safety measures in place. Be bullish, be prudent. To present this, I would like to invite our founder and managing director, Mr. Rajesh Kothari. Welcome, sir.
Good afternoon, friends. Thank you, Sandeep, for that good brief, and thank you everyone for joining in this our AAA Investor Connect webinar. This is our effort to do conference call through Zoom with all our investors and as well as partners to give them market outlook, how we see the market. That's basically the objective of this. At the outset, first, let me share, very good news, to all of you that with support of all our investors and partners, this is the fourth year where our PMS, AAA IOP PMS, which is a flagship PMS of Alpha Credit Advisors, got the award as the best PMS, ranked 3 by IIM Ahmedabad PMS AIF World as an organization. The good part of this award is this is the fourth time we have received this award since the award has been started. So probably we are consistent even in getting the awards, and that basically gives a lot of satisfaction to us while serving to all our investors. With that, let me start talking about market outlook. But before I do market outlook, in the interest of many new joinees, new partners, as well as new investors, very briefly, just in 2-3 minutes, without wasting much time, let me give some basics about Alpha Credit Advisors and also our philosophy, and our process. So this is Alpha Credit Advisors. I'm Rajesh Kothari, founder of the firm. We started this in 2009, and it has been 14 years since we are doing this. Two important USPs about our firm. The one, I am founder and fund manager, so 100% skin in the game. Second, very important, we are not into any other business, so no conflict of interest. Third, we are always available to our clients and partners. Fourth, we are one of the few PMS firms in the industry with 14 years of longevity. And last but not least, in last 14 and a half years, we have delivered about 19% compounded annualized returns to our investors for our AAA IOP, which is a multi-cap PMS plan, and about 30% plus compounded annualized returns for Alpha Credit Advisors Budding Beast, which is our mid and small cap PMS plan. Friends, our investment philosophy is protect capital, create wealth. The protection of capital is very important in our minds compared to just talking about wealth creation. And it is that pursuit of how to protect capital and keep creating wealth, that's where our investment style of causality comes into play. What is the meaning of causality? Is be quality conscious in what we would like to buy, and be agile enough through disciplined exit strategy when it comes to growth outlook and when it comes to the valuations. And it has been that strategy of being agile which has been implemented to its core. We have delivered this consistent performance over last 14 and a half years. With that, let me straight come to the heart of today's topic. How do we see the market? How we are positioned? A little bit update about our portfolio performance. And of course, in terms of the various sectors over next 3 to 9 to 12 months, how do we see the overall outlook from here on? With that, let me share with you a brief presentation. Please give me one moment. Our theme for 2024, after a great 2023, is to remain bullish. We are extremely bullish on the market. But at the same time, our message to investors is that remain prudent. And that's the only way to make sure that you protect capital while creating wealth in this equity asset class. Why we are bullish? Let me share with you 3-4 important slides on what makes us extremely bullish on the market. And actually, it is quite simple. You just have to ask 4 questions if you want to take view on the market. The first question is, what has been the growth? And if you look at the India real GDP growth, it has been hovering around 6.5–7%. Earlier from 2017 to 2019, except the COVID year, we have been growing significantly higher than the world GDP growth. And the classic example is 2023, when the world is entered into a slow lane, like Japan is in a problem, US is slowing down, Europe is of course in a problematic area, China is also slowing down. Unlike the world which is growing at around 3%, India is growing at 6.5%. Double the pace of world GDP growth, that too in an environment where world is in a slow lane. Think of the situation, what if the world GDP growth improves? If the world GDP growth improves, can we do 7%? Can we do 8%? It's possible. In fact, the recent trends and the data points, if you look at it, India has clocked 8% growth. I don't think any macro economist or strategist, globally as well as locally, would assume 8% growth for India for 2024 and 2025. But if it happens, definitely we are going to be in a much bigger bull market compared to what we have seen in last 3 to 5 years. So first, the growth has been very strong. Even if you do 6.5% consistently year after year, we are significantly ahead than the world. And particularly when you look at the world, the most economies are having its own problems. We are in a sweet spot. On top of it, there are opportunities, China +1. On top of it, there are opportunities, Europe +1. On top of it, our dependence on crude oil is reducing significantly. And that makes India really very, very sweet point from the global investors' perspective. Second important question, what has been the quality of this growth? While the growth is good, is it funded by debt or is it funded by equity? And if you look at this chart, this very, very interesting chart, we are showing this chart from last, I think, 6 months. Very, very interesting chart. And look at the second half of the chart first, the bottom slide. The debt levels are constantly reducing. It is not only the large caps which have become a debt-free, but even if you look at the mid-cap companies and the small-cap companies, so this is a blue is BSE 500 large cap. In FY 2013, it was almost like zero debt, and today also it is debt-free. But if you look at the BSE 500, the red color, which is the mid-cap, the debt-to-equity ratio was 0.23. And look at today, where are we? We are negative. Even the mid-cap companies on a median basis have become a debt-free. And what about the small cap, the gray color circle? is for BSE 500 small cap companies, the bottom 250 companies. The debt to equity 10 years back was 0.57, and today even that has become near to zero. It's a very important message I'm trying to convey, that not only the mega cap, not only the large cap, but even mid and small cap companies in India, the debt to equity ratio, they have become debt free. They have become cash rich. And this is something very important, because that means that the quality of the growth, what we are talking about, is funded by internal accruals. And that brings further resilience to the corporate India, the resilience to the banking system, and resilience to the overall economy. Of course, the higher growth also brings with it the better profit growth. And if you look at here, the profit size of the companies, look at that. 2013, the median PAT size was 189 crores. That is moved to 267, and that is moved to 517 crores. So on profit size is becoming 2 times, 3 times, 3.5 times. You look at the different market cap, like large cap, mid cap, small cap, how the profit sizes are moving in each of that bucket. It has been significant growth in median profit growth. And at the same time, the debt equity is reducing significantly. So quality of growth is extremely robust. So again, going back to my previous thing, one, the growth is very strong. Second, the quality of growth is funded by internal accruals and not by the debt. So quality of growth is also very, very good. Third important question is how consistent this growth is. And here is a slide from FY98. So 26 years chart I'm presenting in front of you. And the gray bar shows the subdued growth, and the blue bar shows good double-digit growth. And if you look at this slide carefully, and I don't know how many participants there were there during 2003 to 2006 Indian bull market, when Sensex became 5 times in 5 years. And why Sensex became 5 times? Because every year, look at the blue year after year after year after year, the Nifty reported very strong double-digit growth. 18%, 42%, 29%, just one blip of 9 because of high base, and again 28% and 19%. Very, very high growth, consistent high growth. And after that, almost for 10 years, we are looking at the gray bars. It's very, very flattish, very, very subdued growth. And from there, 2021, Nifty reported 13.4% growth. 2022, again, it reported 34% growth. 2023, we have reported 11% growth. And 2024, 9 months results are already out. And in 9 months, Nifty has reported 17.5% earnings growth. When you see the consistency of the growth year after year after year, it tells you a lot of things. It tells you about how good is the overall macro environment for Indian economy. It also tells you and conveys a message that how corporate India has handled the challenging period of COVID. It also talks about how Indian industry has coped up with the supply chain disruption, which has happened during last 3.5 years, unimaginable supply chain issues, which India has never faced in its history. And despite all that challenges, despite that kind of a very challenging macro global economic environment, India has delivered year after year after year good double-digit growth. So that is the third important point. The consistency of the growth has been really strong. And last but not least, the most important, how do we see the growth from here? And as I said, if you look at GDP growth of 6.5%, 7%, and it means nominal GDP growth of 12 to 13%, corporate India can deliver 14% earnings growth. Please remember, most of the corporate companies are debt-free. So not only operating leverage ratio will help you, but interest rate will not go up, the interest cost will not go up, and therefore profit growth is going to be a little bit higher than the revenue growth. So these are the 4 things which makes us bullish. Strong growth, double the pace compared to world GDP growth. Second, very important, is the quality of the growth is very strong. Third is the consistency of the growth is we have never seen a post-Lehman collapse. This is the first time we are seeing the consistency of the growth. And fourth, the outlook of the growth is pretty green, very, very strong, reasonable outlook on the earnings growth. And that brings the next question, how much we are paying for this growth? Are we paying absurd valuations or are we at fair valuations? And again, if you look at last 10 years, average price to earning multiple, March 2014 to March 2024, our valuations today are almost like reasonable valuations. It is not that we are trading at 20-30% premium to Nifty of 10 years average. We are trading at just 4-5-6% premium compared to its 10 years average multiple. And I'm sure that all of you will agree with me that India has changed in last 10 years. The underlying ROE, the return on capital employed, and the return on net worth of corporate India today is much higher than what we have seen 10 years back. The banking credit system today is much more stronger compared to what we have seen 10 years back. If you look at the NPA of the banks are at all-time low of last 10 years. And of course, on top of it, the benefits of digitalization, the benefit of significant spend on the infrastructure, the benefit of China plus one, and many more such factors. Definitely, can India command 10, 15, 20% premium compared to its 10 years average? Maybe yes. That's how we look at market from here on. So when the growth is strong, when the balance sheet is strong and the valuations are equal to its last 10 years average valuations, that makes us extremely bullish on the market. That also gives some floor to the market because when your PEs are still near to 10 years average PE, your downside is also not going to be significant. But at the same time, we need to be prudent. And why we need to be prudent? Because particularly last 1 year, and within that, I would say particularly last 2.5 to 3 months, there have been froth which is happening in many of the pockets of the market. And very importantly, like for example, SME segment, we have observed that, there is extra froth, is a bubble kind of thing when you talk about SME. And as you go down the market cap curve, the valuations are becoming more and more uncomfortable. The SME is the worst, then the micro cap, then the very, very small companies, and then the small, and then the mid, and then the large. So in terms of the risk reward, or in terms of the margin of safety, definitely is highest with the large market cap companies compared to the very, very small market cap companies. And also I would like to clarify, when I say that there's a froth in pockets of market, I'm not trying to say that mid and small cap there is a froth, because in India, the top 100 is called large cap, the next 150 is called mid cap, but there are 5,000 companies which are listed. So from 250 to 5,000, everything is called small cap. But that's not the right way to look at it. When we look at India, we look at top 600 companies in terms of profit-making companies. And I think there are enough opportunities within this top 500, top 600 companies where the valuations are still reasonable and we do not see any bubble in those kind of companies. So yes, we need to be prudent in terms of stock selection. Yes, we need to be prudent in terms of what we are buying, considering the the governance, considering the management, considering its capital allocation. Historically, whether you look at 99, 2000, or whether you look at 2006, 2008, these are the periods which has given us a lot of learnings. If you look at 2008, 2009 market, the biggest learning is corporates should not get overboarded. Am I right? That was a time when everybody became so bullish that corporate India invested significantly ahead of time without considering the risk on the balance sheet. And they over leveraged themselves. And ultimately that became NPA, and many of the companies, stock price went down by 60, 70, 80, 90, and many of the companies probably are, bankrupt. So I think there's one very important factor, that capital allocation, the risk management of the corporate India is something very, very critical. And if you look at the 99 kind of a market, 2000 market, where also market has seen extra boom, and then of course the crash of the market, it has also given a lot of learnings that again, on the business front, not on financial front, but on the business front, the corporate India, when we select the stocks from the investment management perspective, we need to make sure that what we are buying, they have the right execution plans. It's just not about the stories. Like there are many stories today. EMS is one story, PLI is one story. And 99, 2000 also had many stories. IT was a big story. Many product companies during that time, they became the talk of the town. And afterwards, most of their company, they do not even exist today. So we need to be careful. The ambition of corporate India and the execution of corporate India, we need to be very careful that what is the on-ground execution plan? That's part one. And how do you support that execution plan? Are you over leveraging yourself or you are under leveraging yourself? That's a financial risk. So that's basically what I mean by, need to be prudent. I think particularly from December 2023 to, I would say, February 24 or early March 24, it was like throw the dart, make the money. One can buy any stock and probably the stock goes up 20%, 30%, 40%, and then 100%. I think those days are over. I think 2024 will be year of alpha managers. I think 2024 will be year of differentiation between good quality and bad quality stocks. I think 2024 will be year where you will see the how important it is to allocate to the companies which are fundamentally sound and to allocate the companies where the growth and as well as the balance sheet of the companies are well in place. And if you look at, I think last 1 week or 2 weeks, some correction is already coming in, which is healthy for the market. We are not too much, what I would say, worried about correction. We welcome corrections. I think corrections are part of market. We need such correction for the better, healthier market for the next 2, 3, 4 years. So that's how we look at from the overall market perspective. And with that, let me quickly take you through our IOP PMS as well as budding PMS in terms of sectoral allocation and also in terms of the portfolio characteristics. So as I speak with, currently as I speak with you, this as on February, 29 February, how we are, in terms of the IOP, which is our multi-cap, and also Triple India Equity Fund, which is our AIF, what has been our sectoral exposure. So banking remains about 26, 27%. We have been holding this for quite some time, and we continue to remain there. Capital goods is one sector which we have been bullish from almost like last 3.5, 4 years. We were ahead of our time during that time. Of course, most of these companies, they made their lifetime highs during the recent times. We already did 2 webinars for our investors to explain why we are bullish on capital goods, and our overall view on capital goods remains positive. Of course, within capital goods, we keep changing the companies depending upon the valuations and the growth outlook. Consumer is another sector where we again remain very positive. We holding about 12% in consumer, and this includes most of it is consumer discretionary. Just let me give you one disclaimer. If we talk about any stocks, this is just to give the overall view that how we are positioned, and it is this is not a recommendation to buy or sell a particular stock. And we might be holding these companies in our portfolio for our clients or in personal capacity. So with that disclaimer, like for example, consumer, we have always been very bullish on the discretionary side post-COVID, and again our call reasonably worked well. Trent is our largest holding when we talk about consumer, followed by Titan. These 2 are large holdings, and there are of course many other companies as a part of the portfolio. Software, we have been very, very cautious on the software, and we exited during when Russia-Ukraine war was announced. That was the time we decided to take reduce call on software, which really worked in our favor. And slowly, gradually, we are on a bottom-up basis, we are selecting the companies. The valuations have become now a little bit more reasonable. There has been good time correction in the entire sector. And we are still not very bullish on the sector, but at the same time, we are not very bearish on the sector. Considering the time and price correction, selectively we are buying the software. Capital goods I already talked about. One of our largest holding and the largest contribution to our alpha in last 3 years or so has been ABB. And of course, that has been a very, very rewarding journey. From ABB, considering the valuations moved up significantly, we have exited that and we have moved to some other companies. And we have been, the overall theme remains the same. The data centers, the renewable energy, these are the new growth drivers for capital goods. And we believe the growth will remain strong within capital goods space. Auto and auto ancillary, again, this is a sector where we have been holding about 13%, which we reduced to about 9%. Within auto and auto ancillary, earlier we were very bullish on commercial vehicle space, which we exited during last couple of months. And we have been also very bullish on passenger car industry. That call also, in January, February, we exited even passenger vehicle. And as you might be aware, 6 months back, we identified two-wheeler as a segment, and we added two-wheeler compared to four-wheeler. So both commercial vehicle and passenger car segment, we have exited. Those calls worked really very well, and we moved to two-wheeler. And again, that call is working in our favor. Currently, we are holding like TVS Motor within our auto OEM basket. Auto ancillary is an interesting space. We continue to like this space. We believe that the benefits of electrification as well as electrification will benefit our portfolio companies significantly over the next 3 to 5 years as their content per vehicle opportunity keeps expanding by 2 to 3 to 4 to 5 times. And as that happens, companies which are positioned rightly will benefit immensely in the entire auto ancillary space. Pharma is the one segment where we added the weightage in last few months. This is a sector which we have significantly become overweight during the COVID time, and then we exited completely when the first unlockdown happened in October 2020. And from October 2020 to almost 3 years, we have been significantly underweight on pharma and healthcare bucket. Last 2.5, 3 months, selectively, we are identifying pharma companies, and we believe the valuations have become reasonable. At the same time, the fundamentals have improved because the pricing pressure in generics, particularly in US market, has reduced significantly, which is giving immense benefit to Indian pharma companies with a strong presence in US market in particular. Also, the domestic pharmaceutical market has reported good growth, and benefit of both will come together from this year onwards, which will result into not only better top-line growth, but also better profitability, considering the pricing erosion, which used to happen earlier in US, keeping tab on margins. That is no more now there, and therefore margins will improve compared to what we have seen in last 3 years or so. Power is one segment which we added in the portfolio. As you are aware, we have been very bullish on capital goods segment. And after a very, very long time, we added power also in our portfolio. The primary reason why we added power is because of the one, improved earnings outlook for few large power companies, and also the tilt in their overall mix from not only thermal-based power, but also to renewable-based power. Of course, as country grows, the power deficit is still if you look at the last month also, power consumption has been extremely strong. And as we head for summer months, this can continue, and that can lead to better earnings profitability for few power companies which we are holding in our portfolio. So that's basically the overall portfolio allocation for our flagship AAA IOP PMS. Let me also take you through the portfolio characteristics. Is a true multi-cap with 57% large cap and 18% mid cap and 20% small cap. Irrespective of whatever is the market cap of portfolio companies, all our portfolio companies, they are large by profit size. As you are aware, in India, there are only 600 companies, which makes net profit in excess of 100 crores plus. And most of our portfolio companies, they are 100 crores plus. 68% of the portfolio companies, they are actually 500 crores plus reported net profit after tax. So we don't go by market cap. We always go by the underlying profit size of the companies. A company might be considered as a small cap because if the company don't fit into top 250 companies by market cap definition, company becomes a small cap. But companies which are largest in their respective sector, like for example, TVS Motor and many more such companies, be it a largest company in plywood or be it a third or fourth largest company in pipes or many more such companies, they all are classified as a small cap. Although companies are not small, they are pretty large when it comes to revenue size and when it comes to profit size. How about the balance sheet of our portfolio companies? 67% of the portfolio companies, there was zero debt on the balance sheet. This is again very, very important, the portfolio quality. And 23% of the portfolio companies have debt equity less than 1 time. And this is a very, very rare combination to have the large profit size with a under leveraged balance sheet. And how that is possible? That is possible because they all are market leaders, giving them the pricing power. That pricing power leads to high return on net worth. So our portfolio is a 16-17% ROE, and that they keep reinvesting into the business, resulting into significantly superior earnings growth. So our portfolio for the current year is likely to deliver 30% earnings growth compared to 18 to 20% earnings growth estimate of Nifty. This is the estimates by Bloomberg. So very, very strong portfolio, large profit size, under leveraged balance sheet, high ROE and high earnings growth. And that's what I wanted to again reconnect, be prudent. So there are many companies in India, many opportunities we have seen in last 3 months, 6 months, 9 months, where stocks can double, but their underlying balance sheet was not so convincing. And as a prudent portfolio manager, we have decided not to participate in those opportunities. At times, of course, it is a painful because when markets are wild, the stocks goes up, irrespective of whether debt equity is 3 times or 2 times or 5 times. And that results into underperformance. And of course, as an active fund manager, we don't like underperformance. But I have seen throughout my career of last 25 years that there are times when an investment manager needs to be bold enough to take the underperformance, to buy the underperformance, but do not compromise on the underlying portfolio quality. And that's what I meant by that, be prudent from the investment perspective. And this is something very, very important. The balance sheet basically decides the character of the company. And as you compromise on the balance sheet and or cash flows, that can result into significant higher probability of accidents in the medium to long term. As a prudent investment manager, because we are trustee of your hard-earned money, we would not like to take such chances. And therefore, we continue to remain prudent and quality conscious, irrespective of the short-term underperformance in such kind of a wild market behaviors. So this is about IOP in terms of the portfolio performance. Let me quickly take you through, portfolio performance as well. So this is the calendar years. This is from 2010 to 2023, and of course the current year as well. As you can see here, in most of the years, IOP has done beaten the benchmark. There are probably only, I would say, 2018 was the bad year because that was a year of a concentrated market rally. Only 5 stocks went up. The entire market was basically under stress. But otherwise, we have done reasonably well throughout this journey of last 14 and a half years. Even during calendar year 2023, we delivered 28% returns to the investors. In terms of 1 year, 2 year, 3 year, 5 years, and 10 years, of course, this keeps rolling every month. So, this probably less reliable, I would say tool from when you look at any fund manager performance. But this has been our 1 year, 2 year, 3 year. 3 year is 19.5% compounding, and 5 years 19.2% compounding, and 10 years 20.2% compounding returns to our investors. One important thing, I always talk about the risk-adjusted returns. Beta of the portfolio is less than benchmark. Standard deviation is less than benchmark. and very strong rolling returns, which signifies lesser volatility of the performance, higher consistency of the performance. And this is something very, very important for family offices when you are deploying a large pool to the manager. Coming to budding based, this is our mid and small cap PMS. While it is classified as mid and small cap, we do not buy any small company by profit size. We buy only market leaders, and we have a past track record of delivering significantly higher alpha in mid and small cap. So if we do on a model basis, because it was in IOP, we have been always doing mid and small cap as a part of IOP, then it has delivered 23% compounding returns compared to 10% returns of the benchmark. And that's how we launched this budding beast in 2021. And currently, this is the portfolio sectoral allocation. Engineering again is one of the, is the highest allocation, 19% in engineering. Consumer is 16%, followed by others 15, software 14, automobile, and then banking, finance, and then pharma. Sectoral view broadly remains the same. Of course, the weightages are different depending upon how do we look at the overall exposure to the various companies within the market cap buckets. In terms of the portfolio characteristics, small cap is 62%, mid cap is 21%, large cap is 11%. Few companies probably have shifted from mid cap to large cap because the stock price kept going up, and therefore a few companies went into large cap category. But importantly, I wanted to draw your attention to the profit size. All our portfolio companies, irrespective of its market cap, they are large by profit size. So as you can see here, 76% of the portfolio companies are 100 crores plus. Very, very important. And when you look at the balance sheet, 55% are debt-free and 35% debt equity less than 1 time. This again, combination is possible because they are market leaders. So don't go by the market cap. If the company is market leader, company is oligopoly or company is a monopoly, then they get the pricing power, and the pricing power results into high ROE. And of course, the portfolio is a very, very high earnings growth. FY24, we expect earnings growth of 38% in the portfolio. The 9 months results are already out, and all of our portfolios, be it IOP, be it Budding Beast, or be it our focus portfolio, all three have delivered very strong performance on all 3 terms: revenue, EBITDA, as well as net profit. In terms of Budding Beast performance, this has been the Budding Beast performance on 1 year basis, 48%, 2 years, 28.8% compounding, and 3 years, 30.6% compounding. Against BSE 500 benchmark, 39.5 on 1 year, 2 years, 19.8, and 3 years, 19.5. If you look at BSE 400 mid and small cap index, and I would like to touch base on this as well because you might have some questions. If you look at last 3 months, unlike BSE mid and small cap, which is up 12.6, our performance has been 4.3. Why this underperformance? Because many companies within the entire mid and small cap indices, the stock price are going through the roof, but underlying fundamentals are weak, or they are too much cyclical in nature, where our ability to predict the earnings performance of the company is extremely limited, and or their management and or their governance and or their capital allocation, and such reasons basically make us a little bit averse to buy many of such companies. And repeating my statement, and therefore we decided not to participate in that kind of a high momentum stocks. And even if that results into some underperformance in the short term, we are fairly confident in the long term. What matters is the quality of the companies what we buy, and the growth, and of course the financial discipline. And if we remain disciplined in terms of stock selection, with of course our agility to exit at right time, we believe we can deliver overall in the long term basis significant alpha compared to the benchmark. In terms of the calendar year wise, these are performance on calendar year wise. CY21 50.5, CY22 4.7, and CY23 47.1. I would like to draw your attention to calendar year 2022 because that was the year when we were up 4.7, but the market was actually down. And that's what I meant. When you be a little bit more prudent, and if things goes against you in terms of the market correction or some headwinds at some point of time, then this kind of portfolio basically can weather such storms. And that's something what I was mentioning in terms of the prudence gives rewards at times little bit in the longer term. And this has seen inception absolute performance of 134.5% compared to BSE 500, 80.8%. On risk analytics, beta is less than benchmark. So despite it is a mid and small cap, the beta is less than BSE 500 index. And of course, very strong Sharpe ratio and low standard deviation. So that is in terms of how we are overall positioned in terms of the sectoral view as well as in terms of portfolio characteristics. Let me just spend 2 minutes on our what I would say process or investment style rather in terms of causality. So as I said, we are quality conscious in terms of what we buy and demonstrated through our portfolio characteristics by large profit size supported by under leveraged balance sheet with a high ROE and with high earnings growth. But buying right is only one side of story. What is something extremely important is to monitor the business cycles. Friends, I'm sure you will all agree with me that cycles are changing rapidly. There is no more 5-year and 10-year cycles. Every 2 years, due to certain swings in the global macroeconomics, the earnings all of a sudden takes the U-turn. And this is a slide, although a little bit dated, and we'll update for the next webinar, is how we have basically taken the sectoral weightages during the different times. So like, for example, automobile post-COVID, we made it 11% of the portfolio, started with 5, kept increasing, and auto index also went up. Or for example, capital goods, where we bought 11%. If I'm not wrong, we bought this in October 2020 onwards. We became significantly bullish on capital goods, probably ahead of time. And everybody today talks about capital goods, and index, of course, is at all-time high. Software in March 2022, from 9 to 13% we made. That has been a very rewarding journey. And March 2023, when Russia-Ukraine war got announced, we reduced the software to 7%. And of course, the index also came down by 17%. That's a big number for a IT index to go down by 17%. And this thing we continued every month, every quarter, we keep checking in terms of our exposure, what is the growth outlook and what is the valuation, and keep re-evaluating your portfolio action. The recent example is specialty chemical. I'm sure all of you are aware that we were significantly ahead compared to market when identifying the specialty chemical sector. In September 2020, we were 9% of the portfolio, and we're holding 8 to 10% throughout, I think from 2019, 2020, 2021, 2022. At peak, it was almost 10% portfolio weightage. But in March 2023, exactly 1 year back, we made this portfolio almost zero. So in December 22, we reduced to 5, and by March 2023, we made it zero, near to zero. And today, I'm sure all of you would agree with me that most of the chemical stocks are down by 20, 30, 40%. Few really good names are also down by 20, 30%. We exited specialty chemical because China was opening up. And when China opens up, the prices, we said, probably will not sustain. And if the prices comes down, then many of the chemical companies reported good numbers. But good part of that number was driven by higher realization rather than higher volumes. And that volume, basically, we said, it will take time to ramp up to that level to offset any pricing loss. And that's exactly what has happened. As China opened up, many chemical prices came down significantly, some by 20%, 30%, as high as 40 to 60%. And that resulted into significant dent into many companies' profitability. Many of the companies reported 20 to 30% decline in their profits in 9 months of the current financial year. Of course, we are watching the space very closely. And as and when we become positive, we'll again probably re-enter into it. So we are not bearish on the macro theme. But very important is that how to change the portfolio, keeping in mind the short-term, medium-term, and long-term earnings or the outlook. And at the same time, looking at it, what is priced in? How much is priced in? And we keep asking that question, how much is priced in? And that basically gives you comfort on whether it is comfortable on valuation or not. And based on that, we keep changing the portfolio. There are, of course, many examples of right entry as well as right exit. Whether you talk about Sundaram Fastener, which went up 140%, or Britannia or Dixon, which went up almost 4 times, or Aarti or DVs or Metropolis Lab, and or even the entire specialty chemical pack, be it Vinity Organics, be it SRF, be it Navin Fluorine, good capital goods companies, be it Timken or be it ABB. We keep doing it, and that's how consistently we keep checking and remain agile, be quality conscious, be agile, and that's what result into this performance. So with that, I think I will stop here, and I always prefer to keep it more interactive session. So we probably will open up to all the investors. Feel free if you have any questions and or clarification. And with that, thank you everyone for spending the valuable time. Wish you a happy Holi in advance. And if you have any questions, please feel free to put in the chat box. And with that, I again hand over it to Sandeep. Thank you.
Yeah. Thanks. Thanks, Rajesh. Participant requesting you to please post your questions and queries in the Q&A sections.
So one question, Sandeep, can you start the question? There are some guys who are already putting the question.
Yeah. Can foreign nationals invest in AAA PMS?
Sandeep, you can handle that.
Yeah. In fact, yes. Foreign NRIs can invest, barring US and Canada. NRIs, AAA accept the investment from other NRIs?
US, UK, and Canada.
US, UK, and Canada.
Yeah.
Mr. Kishore Dalal asking, please throw some light on the banking sector outlook for 2024.
Interesting question, Kishore bhai. Banking sector, I think, is 2023 definitely was a tough year for banking sector, and I think the interest rate cycle also takes a lot of. So what we do when we look at banking, so while overall economic growth and everything is, of course, is good, the credit cycle is in your favor, the NPAs are down, so all those things are good. But when we look at banking sector, we look at it a little bit differently. So we look at it in 4 buckets: private sector banks, public sector banks, NBFC, and 4th is the others. This is how we basically segregate the banking sector into the 4 buckets. If you look at the private sector banks, they've been doing extremely well on a relative basis compared to the PSU banks. From 2021, because PSU banks' base was also very low, they had provided significant money as a provisions, and also they were revamping and regenerating the PSU banks versus private sector banks. PSU had an upper hand in terms of net interest income growth, or as well as in terms of the reversal of the credit cost, write backs, and therefore overall earnings, as well as in terms of valuations. So last 1.5 to 2 years, if you look at our portfolio, we have been adding PSU banks since 2021. So we have a State Bank of India, we have a Bank of Baroda, we have a Union Bank. These all are part of our portfolio, and we have reduced private sector bank to a certain extent in last 2.5 years. Going forward, we believe that the valuations of private sector banks are now absolutely in comfort zone. While the growth is still going to be a little bit challenged because deposits, the cost of deposit remains the issue. Unless an interest rate comes down, that will not happen in a hurry. So I think next 2 quarters or so, or next 2 to 3 quarters or so, the earnings growth is going to be under pressure for the overall banking system in general. But the valuations of private sector banks are now attractive. On the other hand, the valuation of public sector banks have already moved up. Still, of course, there is some scope of further re-rating, but by and large, If they go up another by 20-30%, then there'll be cap on the valuation. That's basically between private sector and public sector. Third important is the NBFC. And if you look at 2 years back, we actually shifted our money from banks to NBFC. And we have been reasonably positive on the NBFC space in general. And as and when the interest rates cut happens, and I think it's a question of time, maybe after 2 quarters, maybe 3 quarters, I don't know when, of course, the NBFC will be the first beneficiary of the lower interest rate. And again, in this space, we are holding really few large respectable NBFCs. So for example, we hold Cholamandalam, which is one of our large holding for both IOP as well as budding based. We also hold Bajaj Finance in our IOP. We hold Shriram Finance in our portfolios. These are the few names what we own in NBFC. The fourth is the others. And others is a very, very interesting basket. In others, we put exchanges. In others, we put AMCs. In others, we put wealth management firms. So pretty large universe within others. And here we are playing through exchanges. We have been holding BAC in our budding based and MCX in our IOP as well as budding based portfolio. And those bets are also been quite, I would say, it has been rewarding journey there as well. So that's basically our overall view on banking and finance. Just to conclude, overall bank's profitability is likely to remain under pressure for next 3 to 4 quarters. The valuations of private sector banks are probably how much is priced in? Good part of it is already priced in. The valuations are really reasonable when you talk about the top private sector banks, while growth may take some more time. NBFC, the growth, as and when interest rate comes down, they'll be the first beneficiary of the growth. So growth will resume probably earlier than banks. The valuation, depending upon each NBFC, how they are placed and how they are positioned, we need to look at from that perspective. And in terms of the others is a segment which is a very interesting segment, and we are reasonably positive on other segment. But of course, we have to keep evaluating within that, how to look at A over B in terms of the opportunity cost.
Thanks, Rajesh. There is another question, just an extension of the earlier one, I think. What is the view on banking and NBFC sector in India now, given the RBI trying to stringent the NBFC regulations?
Very interesting question. I think what happened in pharma is now happening to banking. Regulation, the compliance and the risk, risk on the compliance side, I think is going to be extremely important for globally as well as locally. And I think it is very important because the financialization of the economy can lead to significantly higher GDP multiplier. So we are at the right point in terms of the per capita, in terms of the spending. Think of the country. I think 8 years back, only 50% of Indians had bank accounts. Only 50% of Indians had bank accounts 8 years back. Today, probably 90% of Indians have bank account, correct? Through Jan Dhan Yojana. So good part of Indian economy, if you look at the total bank credit of the system, and if you divide in top 10% households and the medium part of say 40% in the 30% and last 70%. Last 70% was getting probably only 10% of the bank credit. And top 10% is getting 50 to 60% of bank credit. Yeah. So now what is going to happen to the middle, the big middle, and as well as the bottom pyramid? They both are now going to be included into the financialization of the economy. Yeah. And as that happens, that will provide tremendous growth impetus to the borrowers, because till now they are borrowing from the informal system, maybe 30%, 40% per annum, depending upon their profile. And when they get banked at 17, 18, 19% or whatever the rate is, their ability to sustain the business and as well as their own income profile goes up drastically, dramatically. And that results into multiplier effect on the overall GDP. And since that's where the inflection point of India is, you have to be extremely careful and prudent enough to make sure that it doesn't result into any, what I would say, bubble into the credit system. And RBI, I think, is the most respected regulator probably in the world, and they're doing their job so systematically year after year after year. And all kudos to the current governor I think it has been super journey, and therefore they are putting the systems in place to make sure that the growth remains healthy. So because they know the financial isn't going to happen, it's going to become 10x, it's going to become 20x, but they don't want any bubbles, any unwarranted practices, the malpractices, because it can work both ways, you know. And I think therefore they are taking the right steps. For us, what is our learning for all our investors? We need to make sure that we just don't buy growth, correct? The growth in ROE is on paper. What is important it is, what is the quality of that growth? Yeah. And last 2 years, 3 years, probably everybody was going overboarding, paying those kind of valuation for just for the growth in that ROE. But if the underlying credit is not good, then it is not about only NPA. I think the important message what RBI is telling to the system is that you might be driving Ferrari, but you have to follow the road signals, you know. And that's the message what RBI is giving. And that's and if you don't, then the penal action is not going to be just monetary, but it can be very harsh penal action. And that RBI has already done to the few institutions in last 3 months. And therefore, I think it is a good, strong message to the industry that please make sure that you don't, please make sure you follow the rules and don't overrule the rules, correct? So I think we need to keep in mind that kind of a risk. Thankfully, our diversified portfolio also again helps us, because it's very difficult to predict such things. When it happens even with the big firms, it's extremely difficult to predict what will happen, where it will happen. So you basically, of course, we remain prudent in terms of selection, but beyond the point, it's extremely difficult to predict such. It's like India's largest pharma company goes US FDA import alert and plant was closed for a few years. And it was India's largest pharma company. So again, diversified portfolio actually helps to cushion if any such event happens. But from now on, we need to keep in mind the risk of compliance when you evaluate the banking stocks in general.
Thanks, Rajesh. Next question. Right. Fed meeting was just at last night. What's your take on your interest rates and inflation in United States? I think Govind sir.
Yeah, sure. Thank you, Sandeep. Fed had their meeting yesterday, and they have maintained the interest rates. But at the same time, they have signaled that high probability of 3 interest rate cuts, which came as a surprise to the markets and investors, and that's where you saw overnight the markets went up there. You know, so now there is a clarity where the market was very, very uncertain, especially after the inflation numbers came for February and also mid-March. So inflation against the expectation went up slightly. And Fed in the meeting has said clearly that they are not so much worried about this short-term movement, and hence they maintained 3 cuts in this year. Now, if you analyze the components of the inflation, the CPI there, you know, so while some components on a YOY basis, there is some increase in the prices which are happening. So headline inflation, which is CPI, which is around 3.3%, can move up a little bit from here. But the Fed follows core inflation, or what is called as the PCE, also private consumption expenditure, where one of the very large component is shelter, which is almost 36%. That is expected to continue to fall because it has a lag effect. So maybe basis all this, Fed has taken a call that they will go ahead with the interest rate cuts in the current calendar year, and which augurs well for the markets. Apart from this, they have raised the GDP estimates for the current year from 1.4% to 2.1%. So it is a 50% increase. It's not a small increase. That shows the underlying, the resilience of the US economy, and on the contrary, I would say the bullishness in the economy. So from that perspective also, I think market has taken it positively. If we analyze the exports, the Indian exports, merchandise exports, which have been negative, but if you see last 3 to 4 months, exports to US have turned positive, and this is good 6 to 7% growth. China also has reported, January, February positive growth. So from that perspective, it is looking like that 2.1% GDP growth can surprise on the upside.
Great. Thanks, Govind sir. Next question is a very clear-cut question. What kind of return one should expect in FY25?
Very difficult to give the answers, because if you would have asked me last year, what return one should expect in FY24, but mid cap went up, 40, 50, 60%. I never see it can correct. I think what happens important is that market is a mirror of earnings growth. And I think in the long term, if you ask me, can India deliver 12, 13, 14% earnings growth? Answer is definitely yes. Within that, we keep investing into companies which can do a little bit better than the economy, correct? And if it is a mid and small cap, they have to do, significantly even better than the large cap companies. That's how we internally look at it. So while I'm not saying that, what return we should expect in FY20, I don't know. But rational investors' expectation from equity market in the medium term from a multi-cap product should be anywhere between 11 to 13, 14%. If it is a mid and small cap product, anywhere from 14% to 17%. That's typically the long term I'm talking about. Year to year, very difficult to predict. And I think that's significantly superior compared to any other asset class. Liquidity is best, and the good part is economy is growing in front of your eyes, Look at, try to book any hotel through booking.com. Normal courtyard, which used to be 7,000 rupees, is now quoting 9,200 rupees, correct? Earlier it used to be actually 5,000, it went up 6,000, now it is 9,000. You visit any airport, there is no place to, actually stand in airport. And if you go and if you visit the lounge, it is worse. You think you are in Kalba Devi of Mumbai and you are at Bhelpuri Wala. There is no, actually, practically there is no space. And this is not only weekends. Even during the working days, you don't get space in, when you go to airport lounges. So I think the growth is happening in front of you. Economy outlook looks reasonably positive. There are a lot of factors, of course, which we have not discussed. Like PLI has been the very good electronic exports, which Govind is just, he was saying the merchandise export. Look at the electronic exports in India. It was not that this number was missing 5 years back. Today, look at the resilience of Indian economy. And I was reading yesterday one very good economist report, and he was writing that the current account deficit can become almost zero in next 2.5 years. Now, these are very big statement. It can be almost zero. We may become current account surplus. And this is what China has been for so many years. Think of a country. Look at our currency resilience. Our INR to dollar, despite so many challenges, problems, this, that, we are still at the by and large same levels. It is not, in fact, people are saying, can dollar appreciate? I mean, can INR appreciate? So I think a lot of things are happening. The growth is in front of you. Only thing is that, as I keep saying, be bullish, but be prudent. Don't go overboard, So that's basically the only thing which we need to be careful about.
Thanks, Rajesh. The next question is, what would be your capital deployment strategy, staggered or lump sum on dips?
In AAA IOP multi-cap, we are recommending lump sum. It is a multi-cap with currently roughly about 60% large cap. The balance is mid and small cap. All of our portfolio companies are pretty large. Our average weighted market cap is roughly 3 lakh crores. When it comes to AAA IOP, which is significantly higher. And of course, with the best of the companies and with the best of the growth. In AAA Budding Beast, we are recommending staggered approach. We are recommending STP. We believe there can be time and price correction. And whenever time of price correction, you always have a discretion to prepone your investment and invest into equity. So we are recommending in Budding Beast, STP of maybe 3 to 4 to 5 months, considering the high valuations. Let me also share with you that when markets were basically become very hot in the month of February end and early March, we actually raised some cash levels, particularly in Budding Beast I'm talking about, just to make sure that we try to protect capital as much as we can. And that basically what we have moved into what I would say higher end of the mid side of the portfolio. So that's what our view as far as the deployment goes. But don't wait too much, too long. Invest money, you put into AAA liquid PMS and start STP if you have a mid and small cap view. But just don't wait for certain election outcome. Everybody nowadays talks about election. What's the view on election? Nobody knows what will happen. But India is growing, correct? And if you have a 3 year, if you have a 4 year, if you have a 5 year view, at times sitting on cash for a long time, you miss the opportunities. So don't wait for a long time.
Yeah. Thanks. Next question. Sir, you were one of the early investors. The question is from Mr. Neeraj. Sir, you were one of the early investors in capital goods sector when most of the fund managers were skeptic. What was the reason and indicators which convinced you to enter capital goods at that time, at the right time?
Hi, Neeraj. Again, good question. In fact, we did capital goods webinar for all our investors when we identified capital goods as a sector. But let me just give you 2 lines, why we became bullish. So capital goods is a very vast sector. It is not a small sector. Traditionally, the growth of this sector is primarily happening through higher capital expenditure on roads, bridges, railways, ports, and airports. When we became bullish on capital goods, we had 2 options: either to buy companies which are in this part of the business or do something else. And we said that there is no point of buying the EPC companies. There is no point of buying road contractors because all these segments are growing at 3, 4, 5% compounded. On the other hand, there are new growth drivers. Like, for example, data centers. The capacity is going to become 5 times in 5 years. Or, for example, smart grid. Or, for example, the entire renewable energy related growth, the EPC companies, capital goods companies within the renewable energy, companies which have the ability to capitalize on automation, companies which have ability to capitalize on the process industry capex. So what we therefore thought is this part B. So what is traditional growth drivers growing at 3, 4, 5, 6%, but the new growth drivers are going to grow at 25, 30, 40%. So we mapped the entire Indian capital goods sector, which are listed companies, and we started mapping who is where, correct? And where are the high growth opportunities and who are positioned for that high growth. That's the one thing. Second thing, we wanted to be very sure, doubly sure, that we don't buy any company where debt equity leverage is very high. Because when you buy capital goods company, you are cyclical business. And if you do go wrong, you can go wrong horribly because company can go bankrupt. So we make sure that we buy only those companies where net debt is kind of a zero leverage companies. Third, we said that we don't want to buy just a company EPC where there is a road ठेकेदार का काम होता है. We don't want to buy the company. We wanted to buy companies where R&D is a more, where product portfolio is a more, where innovation is a more. Based on that entire matrix, we identified 10 companies which are worth investable from a portfolio perspective. And then we identified ABB, we identified Cummins, we identified Hitachi Energy, we identified KSB Pump, the 3rd largest German manufacturing company in India. All these companies, they are leaders in their respective segments. So we follow 3M approach: market size, market share, and margin of safety. We buy market leaders, provided they have good balance sheet, good governance, and good management, and then, of course, good growth. All these companies, they were MNC, so managements were great. They all were R&D driven, research driven, so innovation was great. They all had product portfolio, so they were annuity income. So it is not just not one-time revenue, it is a lifetime revenue. And that gives you resilience to your earnings. They all were zero leverage, so there's no financial risk. And they all were trading at a reasonably attractive valuations when we identified. That's what made us positive on the capital goods space in general, and of course the companies in particular. After that, what happened? In last year, most of our capital goods companies, the companies which we track and invest, they reported 30% growth in order intake. This was the first time post Lehman collapse that capital goods companies delivered 30% growth in order intake. Because today, if you get order, revenue get recognized over next 12 to 24 to 36 months. So in capital goods, you have to monitor order intake growth. And that's how our thesis actually proved right. And of course, that basically helped us to make significantly good returns from our investors' perspective.
Thanks. Next question. How is the 2024 outlook of IT sector, large cap and mid cap?
Interesting question, sir. IT sector is basically primarily is driven by the US economy, because US is our largest export is to US. And therefore, outlook on US economy, while is very difficult to predict, but is equally important. And if you are going just 5 minutes back, going by the Fed meetings, the US GDP growth outlook has been revised upwards. Of course, there are a lot of headwinds and very difficult to predict what will be the final number. But I think the worst is over. Let me put it in that way. The worst is over. Can the good, best days come back for IT companies? We have to monitor. We have to wait and watch. Can IT companies deliver from here 12, 13% earnings growth? Likely. Can mid-cap companies grow better than the large-cap companies in terms of earnings? Again, likely. But in terms of the valuation, how much is already priced in? That's what you have to keep asking. So what we did is that we had a good blend of large-cap and mid-cap in our portfolio. For example, in our budding beast, our largest holding is KPIT Technologies. So what we did is that we said, we can't predict US economy, but what we all know, and I'm sure everybody knows this, is the electrification of the car is happening. The EV is becoming a new reality for the entire world market. And there are only few companies in the world and probably only few companies in India which can capitalize on that opportunity. And KPIT Technologies is one of that opportunity. So we bought KPIT. I'm talking about 2.5 years back, we bought KPIT Technologies. And likewise, a few months back, we bought one product company called Intellect Design in our portfolio, AAA budding beast. Again, that call again went well. I think stock is up about 35, 40, 50% from a purchase price. Again, it's a product company available at a significantly lower valuation compared to even service company, and with the best of the logos in which they are already present, which gives the tremendous opportunity to do the deepening within the clients. They are probably present in most of the banks. They've proven themselves from last 10, 12 years. We saw significant opportunity here. Good valuations, good management, good governance. So we bought Intellect. So we have a good blend of, I would say large cap and mid cap within that. IT is all about new logo wins. IT is all about deals, new deals, what you can get. And of course, IT is all about the culture. How? Because a lot of IT companies we have seen, there is a change in CEOs and change in managing directors. And in a bull market, whenever there's any change in any MD, the stock goes up 50%. He has yet to deliver, correct? And that's where the then problem starts. So you have to be extremely careful what we are buying into. And don't buy narratives, buy the real stories, buy the real underlying thesis. That's what something is very important. So that's basically on the overall, IT sector. Let me also add, IT sector, while it's general IT, but we also have one further new segment added to IT, and that is a platform companies, which also basically is a software, but it's a platform companies. And this is a very, very interesting space. We go by 3M, market size, market share, margin of safety. We identified insurance is a very large segment, the digitalization of insurance. So insurance penetration itself is very low. Within that, digitalization is only 2% of the market. And here we bought a company called Policy Bazaar. We started, our first entry was at 380 rupees, almost when it was 52, we grew at that point of time. And from there, of course, the company has done extremely well. They continue to dominate the industry with more than 90% market share on the platform side of their insurance, without taking any significant payment-related risk, where RBI is very, very cautious and conscious about how this entire payment mechanism is happening. So PP Fintech has not much role to play there and remain the best executor, of their strategy. So that's another segment which we add when we talk about so when you look at a portfolio, overall software, when you do deep dive, it also has a platform companies within it. That's our view on the broader IT sector.
Thanks, Rajesh. The next question is from, are manufacturing and AI big themes now, and how long do you expect them to last?
Two interesting questions in one question. So first is manufacturing. Can manufacturing be big? 100%. No doubt about it. We have to. If we don't, then I think GDP growth will also not come to our favor. Please remember, India has 3 segments: agri, industry, and services. Agri is going through its own challenges due to weather conditions, the water levels. Look at last 2.5, 3 years, agri is not doing well. Services, we are dependent on IT. And of course, now the service exports have also started, which is good. But otherwise, beyond a point, service growth is also linked to the manufacturing growth. If you manufacture more, then ultimately it is its own multiplier effect on the services. So I think manufacturing has to do well. And we are still positive on the manufacturing. That's why You see a lot of capex related companies in our portfolio. PLI is a very big thing from the government perspective, and I think they are very receptive. Whenever it is not working, they are talking with industry, changing the PLI to make sure that it becomes more viable. Our imports are reducing, our exports are going up. Think of a company which is into electronics manufacturing. From 3,000 crore revenue, it is touching 10,000 crore revenue, and probably will become 25,000 crore revenue soon or next 2 years. So PLI, electronics exports, be it a specialty chemical, so manufacturing is going to work. And of course, there are a lot of new technologies, like for example, semiconductor is a new. Now we missed that entire thing in last 10 years. Correct. Now government has finally given the right policy, and I hope it works. And I think it can bring significant investment in India. So manufacturing requires very, very bold steps. And also probably post-election, I won't be surprised if we see the reforms on land and labor side. That also requires, that can give one additional acceleration to that entire manufacturing theme. And that I think is something which is very, very critical for India growth. So that's on manufacturing side. AI, I think AI is a new word, but it's all about different terminology. 20 years back, nobody was using computer compared to what today we all are using them, right? So it is more of a digitalization, whether you want to put AI or robotics, whatever jargon we want to use, was always a theme and will always remain a theme. If your question is, which are the companies which will benefit AI? The companies which are market leaders, who have ability to innovate, who have ability to attract the talent, who have the ability to spend because of the zero date, those are the only companies who can get benefit out of AI, because they will have the right resource, they can have the right talent. If not, they can buy out the businesses. If not, they can appoint somebody as a service provider. If you are number one in AI, they will use your services. So big becomes bigger. That's why our 3M approach: market size, market share, margin of safety. There is not a single company in India which is just doing AI, correct? People use a fancy word, digital data analytics. Now, what is data analytics? It's nothing but Excel, yeah. I mean, we all have been doing it. Yeah, you can do more Python, more coding, and evening 6 p.m. it gives you output. I don't know if you term that as AI, I'm not too sure. But AI is a theme which is happening from last so many years, will continue to happen for next centuries. We should not be overly using and then get companies also command premium valuation. We are doing AI. So I think it's all about the company's resilience. If the company is good with the cash flow, those are the companies which can really benefit. And AI is a theme, no doubt about it. It will become bigger as we speak for next 3 years, 4 years, 5. It will become bigger, significantly bigger compared to what we are talking today.
Thanks, Rajesh. The next question from Mr. Tushar. Hi Rajesh, thank you for your input. One question: who wish to invest now, what will be your strategy specifically in budding beast? With some correction now, do you feel we have got some froth out from mid and small caps, especially in bad names? Also, your way forward during election period, if it's non-event, would you hold some cash during this period to capture any correction?
Multiple questions in one question. So hi Tushar bhai. So first is basically for budding beast, our average weighted market cap is 30,000 crores. So it is actually not a small cap. We do not invest in small companies. We invest into market leaders with a kind of a low leverage balance sheet, high growth, and high ROE. That kind of a portfolio, we believe these are the companies which will survive the what I would say, any correction or whatever in the market. So there might be some time correction, price correction, which is possible, as I talked earlier. But otherwise, we are pretty bullish on entire this space, right companies, top 500, top 600 kind of a companies. Your second question is whether froth is out in mid and small cap in bad names. I don't think in bad names the froth is not yet out. It is beginning. So bad names probably can correct more. As I said, this is a year where there will be differentiation between good and bad. So it is just beginning. And of course, you will see dead cat bounce. And then again, you will see the significant crash in bad names, in those pockets where there is an extra froth. But if you talk about top 600 companies, I don't see significant, kind of a, do we see 30-40% kind of a correction in good companies? I don't think so. Do we see time correction or price correction of 8, 9, 10, 12%? Always possible. 8, 20% is always possible. In mid and small cap is always possible. During election period, does it matter to hold cash? not too sure. I think timing the market is, how to time the market is extremely difficult, and we don't want to be, we don't want to make any experiment. But yes, what we'll do is that if there is any company where valuations have gone up significantly, definitely we'll come out of it and we'll move into the businesses where we see from here the growth and valuation in our favor. Like for example, automobile we have exited, many companies in commercial vehicle we have exited, passenger vehicle we have exited, a few capital goods companies we have exited, few banking and finance names we have exited, a few companies which are into entire specialty chemical we exited, correct? At the same time, we are identifying other opportunities where from now the growth is like two-wheeler, the growth is going to be in your favor. The auto ancillaries which are linked to two-wheeler, growth is going to be in your favor. There are few companies which are power-related capital goods. Growth is going to continue. They've been doing well last 2 years. Probably they will continue to do well for next 2.5, 3 years. Few particular technology companies, like I talked about one of the product company name, the growth is going to be reasonably strong. So there are so many pockets of opportunities. We need to keep your eyes and ears open and keep evaluating those business and keep buying them. So long term, we remain positive. Don't wait too long. Don't hold high levels of cash.
Thanks, Rajesh. Next question from Jainam. India Incorporate has healthiest balance sheet in the longest of time. Government of India has done a lot of capex through PLI, etc. in the last couple of years. When can we see private sector capex kicking in? What are a couple of metrics that you are looking at to track it? And are there any pockets or industries where you are already seeing it? There are a couple of questions in one question.
Yes. So basically, the net one question is when we expect private sector capex to move up. Very simple, and it's a very good question. I think if you look at the corporate profit to GDP ratio, it is now moving up. After touching an all-time low, it is now coming back. And as corporate profit moves up, the balance sheet becomes healthier. And as balance sheet becomes healthier, your ability to do next level of capex goes up. So that is a one side of it. The supply side of it. Am I capable to do capex? That's one part of it. So yes, you can do capex. Your balance sheet allows you to do capex. Your debt to equity has become zero. Bankers are after you. Please take some money so you can get easy loan, or you can raise money from market. So your ability to do capex is in your favor. Number one. Coming to the demand side of it. Demand side, the capex utilization is improving slowly. So if you look at a few sectors, like particularly, for example, cement, we are almost running at good utilization. If you look at the north part, west part, except south part, most of the regions we are seeing significantly high utilization in particularly last 2 years. So as capacity utilization keeps hitting the roof, and every corporate knows that if they continue this kind of a 12% nominal GDP growth, you do plan today for your capex to come on stream after 2 years. So we are seeing significant amount of capex to happen from the private side. A lot of companies have already announced the capex plan. Steel industry, for example, announced a very big capex plan. Power industry has announced very big capex plan. Earlier, these used to be oil and gas. This time, oil and gas is missing. But we are seeing significant capex by power sector, significant capex by steel sector, significantly good capex by cement sector. These three are the large blocks. Of course, automobile keeps doing the capex because for them it's more like a secular growth. Also, there is a lot of capex from thermal to renewable, correct? So from coal-based power to the renewable power, everybody would like to do it. Waste recovery plant, everybody would like to do it. What is the indicator to see is it happening or not? Again, good question. Look at the order intake growth of the top 10 companies of India. Look at L&T order intake growth for 9 months. You will see the result. Look at the order intake growth of ABB, Thermax, Siemens. You will see reasonably good numbers. Sometimes the base effect also plays out, so you need to be a little bit careful. But otherwise, most of these companies are reporting good order intake growth. Data center capacity is becoming big. These are the indicators which we have to monitor to decide will it continue or not.
I'll add to what Rajesh said. One another very important data point to track is the capacity utilization of India Inc. This is RBI data. The capacity utilization is highest since last 15 years. It has reached to almost 76%. And as our GDP growth, which is now 7 to 8%, as this growth continues, the capacity utilization is moving towards 80%. And that's where across the sectors, the big private capex starts to happen, you know. So one can say that while Rajesh has given details about the few large industries, but if you see at more granular levels and across the sectors, maybe we are at very close to that level when we see that happening.
Thanks, Gunji, and thanks, Rajesh. The next question, with interest rates expected to fall in USA by year end, will it be bullish for US economy? And if so, what are your views on IT sector?
We already covered that, Sandeep.
This is already covered.
We are talking in detail about it.
Yeah, detail. Next question, what would be your thought if an investor considers to move funds out of the IOP, large multi-cap, into the mid and small cap strategy with the very good debt profiles of mid and smaller companies? Aren't growth opportunities better there? It simply is trying to ask Mr. Chintan, asking, is it the right time to move from IOP to budding beast?
Hi, Chintan. No, I don't think so. So first of all, yes, from segment multi to mid or mid to multi. First of all, very important is your overall allocation to equity. Number one, within equity, how much is multi cap and how much is mid cap and how much is small cap? That needs to be frozen first. So it is not a one answer. If you have a zero exposure to mid and small cap, then probably yes, you may consider. You have a significantly high exposure to mid and small cap, then you should not consider. So I think one is the asset allocation. Second important thing, as I said, from the valuation perspective, today multi-caps are better positioned compared to mid and small cap. And that's the reason why we are recommending lump sum investment for multi-cap, whereas staggered approach over a period of 3 to 4 to 5 months for mid and small cap PMS. So that's what our view is. I think multi-cap today, if you ask my personal view, is the best position from the growth, valuation, and as well as from the downside perspective. All three put together, multi-cap in my view is a first preference. And by the way, in multi-cap, you also have mid and small cap, 30, 40, 50% is already so. So it's not that you are going to be deprived of any significant rally. If suppose mid and small cap tomorrow goes up, say 100%, for example, it's not that you are going to be, not get any benefit out of it, because in our IOP multi-cap, we hold, 40, 45% mid and small cap. So you will get benefit in both.
Yeah. The next question, I think, is also covered already. I am aware that you were one of the very few fund managers to take early exposure in specialty chemicals, and you made good profits in that. What is your stance in that sector now? Are you increasing exposure?
See, what is happening is, on specialty chemical side, we exited in March 2023. And, after that, China opened up. And when China opens up, it opens up in a big way. Most chemical prices are down 20, 30, 40, 50, 60%. Few chemicals are there 50-year low. So we are monitoring it. These prices of chemical are not sustainable in the long term, because at that prices, even China is not going to make any profit. So yes, we have to monitor it carefully. We have to monitor it very closely. And at the right time, we have to look at it. The another thing is, the problem is the chemical companies, while the, correction has been there, but it is not that sharp correction in terms of the valuations. So the growth is still subdued and valuations are still not that attractive. So maybe, like last time I was saying, like IT, it will move more into time correction for some time, price correction, some time correction, and then at right time again, we'll be looking into it. Currently, we are not yet positive on that. Yes, there are a few companies which are on our radar, and we are closely evaluating it for investment decisions.
Thanks, Rajesh. Next question, which sector would you concentrate on going further for next 1 to 3 years?
I think a few sectors on which we remain positive. The first is auto ancillary. We like this sector. We believe there are a lot of opportunities in auto ancillaries. The sector is going through a transformation, and there are really good companies which can capitalize on this change in the from ICE to EV or ICE to hybrid. There are few companies which can take really benefit out of it. So we are looking at that sector. Second is a consumer sector where our discretionary we expect to continue to do well. The real estate proxy companies, we have been positive throughout. Of course, we kept changing our allocation within that. But whenever the real estate cycle, finally the lag effect comes on the building material, we have to monitor that second thing. Third is basically the capital goods, manufacturing. We remain very bullish, no doubt about it. Our portfolio shows that. So we are extremely bullish on the overall, capex as a theme. Healthcare on select basis, we are becoming incremental. If you ask me, I'm taking this question more as an incremental. Pharma is one space incrementally. We are getting positive. We have been adding our weight into the pharma space. So, we are fairly diversified. There is not like one single sector where we become extremely bullish or bearish. We are fairly diversified, and opportunities are across. We need to be bottom up. Watch for your market size, market share, margin of safety, and take the right allocation in the portfolio.
Thanks. Next question from Mr. Lalit. Weightage of a renewable sector in IOP is low or almost negligible. What is the reason?
No, in fact, we have a good exposure, but I don't know how one looks at renewable. Renewable is just not about the power utility companies. Renewable is also about the capital goods companies, which serves to those companies which already have a renewable energy. So product portfolio is a very, very important. So we have many companies which are into the product portfolio side of it. Also, pure renewable companies are very, very limited. There are hardly two companies. When you talk about the capital goods side, we are holding one of them within that, within renewable capital goods. Also, for example, the utility companies, they also have a renewable exposure, and we are holding Tata Power, for example, in our portfolio. They have a good renewable exposure. We are holding, one capital goods company, EPC company for the renewable. That is the second largest player of the country in the renewable capital goods. So we have a reasonably, it is not like huge, large portion of the portfolio, but we have I would say a good presence in renewable. Please also keep in mind that, there are a lot of regulations in this power sector, telecom sector, highly regulated sectors. So those are the risks which you take when you take, why we don't have significantly higher exposure. Suppose if your question is that, because there are a lot of regulatory related risk, and you don't know what announcement will come tomorrow. And it has a significant impact on the business models of the companies, on power tariffs, for example, or the availability of the, can you sell power open market, for example, at what rate you can sell, for example, the cap on the power prices, for example, the incentives for it, for example, making renewable A versus B. For example, if you are into solar versus wind, attractiveness of one versus other, for example. So there are a lot of things within that which are purely policy matters. It's the hand of the power ministry. And we don't know, what can get announced. And so you again need to we take a measured approach while taking exposure, particularly to the sectors where the regulatory risks are very high. You look at, for example, oil and gas, like CGD companies. They are very good companies, but one or two announcements in the recent months, and you look at the stock price of that. Companies are really very good. Those are the regulatory. You need to take a measured approach. At times, you may, as I kept saying in my opening remarks, sometimes by not having, you may underperform, or having less, you may underperform. But you can't do anything about it, because like CGD, if you get one announcement tomorrow, it will go down 35-40%. What you will do? And you can't actually predict that, because it comes from north. So we prefer to take a measured approach and take the position accordingly.
Thanks, Rajesh. The next question is from Mr. Shri Balaji Sampath. Yeah, simple question. Any interesting IPO in the radar in near future?
In IPOs, typically, most of the time we reject most of them. There are only few select, which we like. In those select things, we look at how much can be worth subscription. Is it a waste of time, or does it make sense to apply? If the company is good and the valuation are reasonable, even on listing, then we participate. Correct. We've been holding few names since IPO times, and we made extraordinary returns 4 times 5, like Prince Pipes. Post IPO we bought, and we exited when it became 5 times from our purchase price, or 4 times from our purchase price. Or for example, Polycab we bought at the time of IPO, and of course we made significant gains. I think we bought for 450. We exited at roughly 3,000, something like that. So 3,000 or 4,000 probably. So almost 8x. So we keep looking at every opportunity, be it a IPO or be it not an IPO, or be it a to be listed or when it gets listed. We look at every company, but if it fits to our investment criteria, then we buy it. If not, we skip it.
Thanks, Rajesh. That brings the end of the question queue, in fact. And thanks, everybody. Thank you all. Thanks, Rajesh. Thanks, Govind sir. Thanks all our partners and investors. Thanks for finding time in your schedule. And before closing, just wishing you the happy and colorful Holi. At the same time, the most prosperous financial year also going ahead. Thank you.
Thank you. Thank you, friends. Thank you very much. Bye-bye.